What is going on, investors? Welcome to my channel. This is the Frugal Investor. In the previous year, the Federal Reserve has been buying a lot of US assets, that is, US treasuries and mortgage backed securities. That is, they are increasing the money supply in the economy. Now, there have been recently talks that the Fed is trying to taper. That is, they are trying to reduce the amount of assets that they are purchasing every month. That is, the amount of money that is going to be circulated in the economy is going to be limited. When that happens, the banks they have less money to lend out. When they have less money to lend out, they become more selective in who they lend the money out to, and thus the interest rates go up. In this video, I am going to give you guys three best stock picks in my opinion that are going to get you through these tough times. If the interest rates go up, these stock companies will do really well and will come out as winners. Please don't forget to like and subscribe to the channel. With that said, let's get right into it. When the interest rates go up, the best companies to invest in are the companies with low debt and more cash on hand. So when the interest rates go up and the debt payments become too high, they can use that cash to service that debt, and thus the interest rate payments don't cut into their profits. The first company on this list is Costco. Costco is a great business. It is available at a P by E ratio of 42 right now, which is a little bit high for dividend investors. But looking at the business, looking at the market, looking at the situation that are going on in the economy, this price is a great price to pay for a business that's so well run, so much in demand, and it's such an essential business for our society. Within the past year, the stock is up by almost 33%. If we look at their top line, the top line has been constantly growing over the past 10 years. That just shows you the scale that this business is growing at. If we look at their bottom line, the bottom line has also constantly been growing over the past 10 years. That is a great sign that this business is very well managed and is so much in demand. And that's why, as I mentioned before, 42 P by E ratio is so justifiable to pay for a business like Costco. If we look at the amount of debt that the business has, the total debt that's on Costco's balance sheet is $10 billion, and the amount of cash that they have is $11 billion. So they have more cash than they had debt. So if things go south, if interest rates go up, they can use some of that debt cash to pay off that debt and still be in the green. That is a great sign of a well managed business. Costco is also a great dividend payer. Now, their dividend yield is not that high, but they have been paying out their dividend, and the dividend yield is 0.70%, and the annual payout for their dividend is $3.16, and they pay out their dividend quarterly. Costco has been paying out their dividend since the 2007. So they have been paying their dividend for almost 14 years without haste. They have never stopped paying their dividend. This is a great sign, and they have constantly been increasing their dividend as well over the past 13 years. The second business on this list, guys, is Johnson and Johnson. Johnson and Johnson is mostly a pharmaceutical companies, but they are very well diversified across different products, and also they are available in so many markets. Johnson and Johnson is available in almost every country in the world. Their products are almost available everywhere, and the P by E ratio that this stock is currently trading at is 18.46, which is not a very high P by E ratio, which shows that this stock is still available at a good price. Within the past year, the stock is up by almost 18.74%. If we look at their top line, they have been constantly increasing their top line. It has been fluctuating because this is a very old and very well managed revenue machine, but they have still been able to increase their top line, which is quite impressive for a business of this size. If we look at their bottom line, now their bottom line has been fluctuating, but this is a profitable business. And on the long term, their bottom line shows a straight line up because the bottom line has been increasing. In the year of 2017, the bottom line, they it shows that they didn't make any profit because they were buying a Swiss company, a Swiss pharmaceutical company. So most of their profits went into acquiring that business. Johnson & Johnson is also a dividend payer. They pay out their dividend yield is 2.37% and the annual dividend payout is 4.24, $4.24, and they pay out their dividend quarterly. Over the past 30 years, Johnson & Johnson has never missed a dividend payment. They have been paying out their dividends for the past 30 years. Now, that is really very impressive. Not only that, they have been constantly increasing their dividends over the past 30 years. So that shows that this business is very, very safe with a safe dividend payer, a safe dividend paying history, and a continuous amount of increase in their dividend payments over the past 30 years. And not only that, they are profitable. They have an increasing bottom line and they are so well diversified across different markets. So businesses like this are in such a great shape. If anything happens with the Fed, if they increase the interest rates, if they start tapering, if they stop buying if they stop doing asset purchases, businesses like this will make you a winner because at the end of the day, you own parts in a great business. The third business on this list is a bank, and it is one of my favorite banks. It is one of the largest banks in the United States, and this is none other than JP Morgan and Chase. Banking was such a beaten down sector just 9 to 10 months ago, and now it's roaring back. It has come up in full swing within the past year. Stock is up by almost 57%. The stock is available at a P by E ratio of 11 right now, which is still very, very cheap. And this is such a great business to buy. The CEO is Jamie Dimon, which is one of the most respected bankers in the world. If we look at their top line has also been constantly increasing. Now, it does fluctuate from here and there because of the pandemic. They were putting a lot of cash on the side to be safeguarded due to the Federal Reserve policies for the banks. But overall, their top line has constantly been increasing. Not only that, even their bottom line has been constantly increasing in the long scale. They are a very profitable business. The thing that impresses me most about this business is the amount of cash they have on hand. They have $1.5 trillion cash on hand, and the amount of debt that they have is only 721 billion. So they have almost double the amount of cash that they have than debt. So if things go south, if interest rates go up, they are more than safe, more than safe position to service their debt and to still be come out as winners because of the amount of cash that they have on their hands. Dividend yield is 2.33% and they pay out an annual dividend of $3.60 and they pay out their dividend quarterly. The 5-year growth rate for their dividend is 15%. That is very, very impressive. JP Morgan Chase has also been paying out their dividends for the past 25 years. Now, they did cut down the dividend in 2010 during the financial crisis when the banks were in a very tough spot. But overall, they have never missed out on their dividends and they have constantly been increasing their dividends, which is very, very impressive for a business of this size. All these three businesses, JP Morgan and Chase, Costco, and Johnson and Johnson, are safe blue chip dividend paying companies with very well run and managed businesses. And that is what I promote on this channel. Safe blue chip dividend paying companies that you can own in your portfolio and you can weather any storm in the long term. In the short term, no matter what happens, you will always come out as winners because America is growing and you own parts of good business in a great country which is growing. No matter what happens in the short term, interest rates go up, the Fed tapers, there is less money circulation, these businesses will still win. Banks, I know a lot of people hate on banks. Banks, they make money when there's low interest rates, they make money when there's high interest rates. They have been here for a long, long time and they will continue to be here. They are the pillars of this economy. And that is why I am so bullish on banks, JP Morgan and Chase. To give you guys a quick update on my portfolio, currently we are up by almost 22% for this year. Just today alone, we are up by almost 0.76%. Now, the market has been fluctuating over the past week. This week, the market has gone down and up a lot, but short-term fluctuations don't bother us. We hold parts of good businesses in our portfolio, and we're doing really, really well, up by almost 22% in the past 7 months. Dividend income of $1,700, $1,800 just in the past 7 months alone. So With that said, guys, check out my M1 Finance Buy. I will leave it in the links down below. And these are my three solid picks of businesses. If the Fed tapers, the interest rates goes up. If you like this type of content, please like and subscribe. Thank you for watching. This is the Frugal Investor signing out.